Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And in this video, we're going to cover how cash flow works with regards to rental real estate. Now, if you've never owned a property before or rental property before, you may have the idea that landlords are swimming in cash flow. And the answer is it depends, because it depends on the type of house that you buy, at what price point, and what kind of rents that you can get. And usually there's two types of rental real estate, or the type of return that you'll get. The first type of return that you might get is just pure income, right? So maybe this is a cheaper house and maybe not in the best area. Um, it's a cheaper property and you probably buy it for all cash. So let's say you got a $50,000 home, and I'm pretty sure that that's not, in Metro Georgia, because a lot of the properties here are probably above 300,000. In fact, I think in the country the average property value is $400,000 now. But I'm pretty sure there's some pockets in the country where properties are still cheap, where you could get a $50,000 property for $700 of cash flow, and that means all expenses. Normally, you would just buy it in cash, so you have no debt. But the other thing, the con of that is that you have no appreciation. So maybe like it's $50,000 when you buy it, but when you have to sell it, maybe you'll get 70 or $80,000. Maybe on a good day, $100,000, right? But so it's cheap property. You get the cash flow, but you get no appreciation, right? And then the next type of property that you would get is something called growth, meaning you might get no cash flow, you may get little cash flow, you may even get negative cash flow. So, for example, if I buy a property in Hawaii, Hawaii properties are like $1 million, and I rent it out, I'm probably not going to get positive cash flow. So you buy it with debt, more expensive property, but you get a lot of appreciation. Actually, let me fix this spelling. Appreciation. So this probably happens in the more expensive markets like New York, California, Hawaii. Um, Maybe it's happening in Georgia. Georgia is kind of in the middle here, but you have to decide what you want. Do you want to buy a property with debt and not really get the money now, but get it for later? Or do you want the money now, but you don't get the big payday when you sell? And so that depends on you. And because I'm just trying to invest locally. Properties in Georgia, or at least where I'm at in Metro Atlanta, don't really have income, especially because I'm buying the property with some debt, right? If you have no debt, then the property will cash flow really well. But if you have debt, you're probably not going to experience cash flow. And it's kind of like, oh, you're getting a retirement fund that your tenant is kind of paying for, right? So let me just pull up a spreadsheet right here. So here's the thing. You can just do a cash flow analysis of a rental property. You just have to take into account the expenses. And one of the things, before I get into that, is just mention is that there's no real relationship between rental prices and sales prices. So if you think you're going to buy $1 million home in, let's say, San Francisco and be able to rent it proportionally to maybe a $200,000 home, that's not going to happen. So for example, in Georgia, maybe if you have a $200,000 property, it may rent for $2,000 a month, right? But if you buy a $1 million property in Southern California, you may only rent it for $4,000 a month. So if I have five $200,000 properties in Georgia, I'm making 10K. Whereas with that $1 million property in Southern California, um, you only get 4K. So again, there's no real relationship. There's also something called a price to rent ratio that can figure out that you can see, like if you want to see a numerical relationship between the rental price versus the purchase price, but they're not really related, although they do keep track of them. Okay, so back to my point. So we're going to do a cash flow analysis, and it's just really easy, right? So basically, how much can you charge rent? So how do you know where you can charge rent? You can use a tool like rentalmeter.com. That will give you comps. I actually don't know where they get their data from, but I've used it before and it seems pretty decent. And that's how I'm able to know how much I'm charging rent. Um, Another way is maybe using tools, sites like Facebook Marketplace. I heard that's a really popular way of finding renters, even though I've never used Facebook Marketplace before. Um, Craigslist. So here's the thing about how you know what the market is telling you what's the right price. If you price something too high and you're not getting any takers, that's the market telling you that nobody can buy, like at that price, nobody is really willing to buy. So you kind of have to lower it, and then once you lower it and you get more people interested, then and you're able to rent it out, then you know that that's the right price. But high prices in general, if you're let's say renting out a property at a certain price and you have no takers, that's essentially the market telling you that that's not the market rate for a rental. So if that makes sense, okay. But let's just assume that we know that the rent is $2,000, taxes about $100 a month, insurance is $100 a month. Again, these are just estimates. Um, Debt. Okay, so here's the thing. So when we have, let's say, maybe a $2,000 a month of rent in Georgia, because Georgia is more likely a growth area than income, we need debt to buy it at $200,000, and at 80%, $200,000. That's for about $1,400 a month. And then we also have to account for vacancies, although some people don't like to account for that, and even other things like what else? Maintenance and stuff. But let's just do a quick analysis. So what we're going to do is put the rent in green. So let's go ahead and do that. And then all these other ones in red. So let's go ahead and do that, right? And so what's our cash flow, right? So let's just figure out what our cash flow is. And it's basically the green minus the red. Maybe I forgot a few expenses, but these are kind of like the main ones. So equals B2 minus B, I'm sorry, not minus B6 minus B3, B3 minus B4 minus B5 minus B6. And let's see what our cash flow is. And so as you can see right there, with debt, our cash flow is only $200 a month. And that's if everything goes well, right? Because there could probably I don't know, unexpected expenses, something like a water heater may go out. We didn't really account for that here. But let's say that the cash flow is about $200 a month. Now, is that something you're willing to receive in order to get that big payday in maybe like 10 to 20 to 30 years, right? So that's why debt is kind of like a cash flow killer. I know like Robert Kiyosaki says, oh, get as much debt as possible, but I don't even know how you're making cash flow if the rental price doesn't cover the debt and you're getting like extreme discounts. Because even though this property is discounted, let's say it's actually a $300,000 property and I have a $200,000 loan, if I could only get $2,000 in rent, then I'm almost near zero cash flow, right? But let's see what happens with just taking out the debt, and this becomes zero, no debt. You can see that the cash flow goes from 200 to 1,600, and that's why paying off your debts with regards to rental real estate is really important, because debt is the cash flow killer, right? It's insane. But that's why when it comes to buying rental real estate, you either in one of the two situations. Now you could get growth and income if you pay all cash, but it's unlikely you're going to pay all cash for the more expensive properties when you're engaging in rental real estate. Okay, so this was a pretty quick summary of how I think about rental real estate. Obviously, there are other ways to cash flow higher in real estate, such as doing like short-term, mid-term rentals. I'm thinking about doing that. So one of the most popular strategies is Airbnb arbitrage. So basically, you rent a place, maybe rent a couple apartments, and then deck them out for like $20,000 each. And then I've seen an instructor of ours who teaches that short-term rental class make like $50,000 to $90,000 a month in revenue. I don't know how much of that is profit, but I was like, dang, like if he could do that, man, and get that much money in 1 month, that's way better than getting my $200 a month in cash flow for the rental real estate. I kind of want that cash flow now, but that's pretty much how rental real estate, especially with single family homes, works. I think multifamily might be better, but but I'm thinking, hey, I got to explore all my avenues. And that's kind of one of the things that we offer in our group. And I'm making a plug for our group right now. We offer education. We offer education in almost every aspect of real estate. And it's not taught by me, it's taught by experts who've done more than $1 million in revenue in their field. Or I don't know if it's profit or revenues, $1 million more in their field. So if you're interested in joining our group, go ahead and click the Google form link below and to check out our educational resources, or you could send us an email saying that you're interested in joining a group. All right, so I hope you learned a lot regarding cash flow and rental real estate. Have a great day, and we will speak next time.